Welcome to Building Blocks for Apartment Investing. On this episode, we have special guests, Eric Stewart, the owner of Atlantic Business Capital, Inc., and Shad Hammond, the senior loan consultant with the Loan Depot. These two experts are here to share their thoughts on the effect of current interest rates on multifamily and residential property investments. This is a three-part series that I'm sure will provide value to you in building your portfolio. Enjoy the show. Before we get to business, I usually like to start things off with networking because this meeting is not only for information sharing, but it's also a networking opportunity. So at the beginning of each meeting, I like to give everyone the opportunity to do an elevator pitch and then place your email in the chat so the right people can connect and we can make deals happen. For anyone that hasn't heard of an elevator pitch, it's a brief and concise speech that tells about who you are, what you do, and what you want to achieve. It's named that because it should be short and compelling enough that you can introduce yourself during an elevator ride. It's a way that you can share your credentials and expertise quickly with individuals that don't know anything about you. For example, here's mine. Hi, my name is William Madison. I have a 25-year background in construction that includes over 10 years of experience in multifamily and commercial property management. I have worked as a service manager for multifamily complexes up to 490 units. During that time, I earned the OSHA 30 certification for site safety and a diploma in HVAC. A few years ago, I became a licensed realtor. I've learned how to underwrite multifamily deals, how to verify if it's in an emerging market, and with my background, I can quickly evaluate what the property will need in order to reposition it to achieve market rents and raise the property's value. I'm currently sourcing deals, and if you would like information about them, I would love to share that with you. Next up will be our co-host, Cedric Marlow. He's a local investor with many years of experience on the GP and LP side of apartment deals. He has also taken part in securing money for several deals as well. Cedric, please introduce yourself.
Thank you, William. Good evening, everyone. My name is Cedric Marlow. I am managing partner of Cobbs Creek Capital. I am currently invested in 109 units and currently have 26 units under contract. We here at Cobbs Creek Capital raise capital for multifamily apartment communities in emerging markets across the country, where we provide our investors a better than average return on their investment. Our mission here at Cobbs Creek Capital is to provide our investors an alternative investment opportunity. In addition, we provide our residents a clean, comfortable, safe environment to raise their family. Back to you, William.
Awesome. Next, we have Daniel Olmsted. He's an associate consultant at Morgan Samuels Company, and he's the marketing coordinator for our organization. Daniel, please introduce yourself.
Thank you so much, William. Thank you, everybody. My name is Daniel Olmsted. I'm a realtor based out of the Philadelphia area. My other hats that I wear: resume writer, more recently published author, as William mentioned, and associate consultant for an executive search firm, creating the leaders of tomorrow. Currently learning 3 languages, Chinese, French, and Spanish. And I am pursuing law school in fall 2023, but right now working on building my portfolio to be able to meet demands. So if you'd like to learn more about me, feel free to visit danielolmsted.com, or you can check out our website as well, Building Blocks for Apartment Investing online.
Thank you. All right, everyone. Now that you've heard a few examples, it's your time to shine. For anyone, if you need assistance putting together your elevator pitch or with public speaking in general, I'm the current elected president of Northeast Philly Toastmasters Public Speaking Group. By joining the club, we can assist you in developing the skills that you need to quickly and confidently get your point across to buyers, sellers, lenders, and investors. You can find the group link on the digital business card that I posted in the chat. We are here to provide value to you in building your multifamily property portfolio. One way that we provide value is by bringing special guests like we have here tonight, Shad Hammond and Eric Stewart. Eric is the owner of Atlantic Business Capital. They provide commercial real estate mortgage services such as non-recourse permanent loans, short-term bridge debt, long-term equity positions, and short-term transitional equity funding. Shad Hammond has many years of experience as a senior loan officer for companies such as Freedom Mortgage, Princeton Mortgage, Movement Mortgage, and he is currently the senior loan consultant with the Loan Depot. Thank you, gentlemen, for coming tonight to share your expertise with our members. Eric, please share a little bit more about your background.
Thanks, William. I appreciate that, and thank you for having us on the call this evening. My name's Eric Stewart. The company's Atlantic Investment Capital, and we focus on commercial real estate debt. We don't do any type of single family, but we try and stay in our lane with just focusing on 5 or more residential units and the various commercial food groups, retail, office, industrial, and so forth. Started the company in 2004. And at that time, I was really focused on serving the residential brokerage community, the residential mortgage brokers, who really didn't want to go out and build their commercial back room. And then in 2007, 2008, when the whole debt market shifted, that's when I shifted and really started to lean into the individual investor. Since then, it's been a wonderful focus. I've been able to help investors that are transitioning into the multifamily space expand their portfolio. And one of the biggest things that I try to impress on my new clients is not to stop looking at the single family market, but just open your lens a little bit, open your potential investments to include multifamily and have that diversification in both, because single family can be an incredibly lucrative section. Multifamily can be incredibly lucrative as well, and they both have a place in a well-diversified portfolio. So thank you so much for having me, and I'm excited to talk with everybody tonight.
Great. And Shad, please share a little more about your background with our members.
I am Shad Hammond, team leader at Loan Depot, and I have a background first and foremost in TV and radio. And a couple years ago, a friend of mine asked me, he says, I know you don't know much about the financial side of real estate. I am also a licensed real estate agent as well. He said, I know you don't know much about the financing side, but we're experiencing one of many refi booms that we'll see from time to time. And I jumped in on the refi boom wave and did very, very well. And one of the reasons why I stuck with it, because I enjoy helping people, and I enjoy helping people solve problems. And that's what Eric and myself do. We help people solve problems. And one problem of many in our world is that people aspire to seek, those who have the savvy to seek passive income, right? And we know several ways that people can obtain that, but I try to offer a safe, efficient way to obtain passive income through using real estate as an arena. And, here at Loan Depot, I am the chief home ownership strategist, licensed in 39 states to do mortgage. I've closed over 1,100 loans in about 8.5 years. And, it's a fun job. So happy to be here tonight, gentlemen, and hope to add value.
Once again, thank you, Eric and Shad, for being here this evening. So we have a few questions for you, gentlemen. First off, Eric, what are your thoughts on the current interest rates? Also, what are your thoughts on the current economy and its effects on the interest rates?
If I had to summarize it in one word, I would say we're in a transition mode. And in any economic cycle, when you're in that transition mode, you feel the pain, you feel the uncertainty of it. And right now, our rates, and this is in the commercial space, because one of the value points that everybody's going to get from this call is to hear the commercial side and how that's underwritten, and then also hear from Shad and the single family market is underwritten, that 1 to 4 space, because believe it or not, guys, they're different. They go in different investment tranches from these lenders. Fannie and Freddie have different programs for them. And from my world, in the commercial side, the benchmark index that we focus on is the 10-year Treasury yield. And, as that moves up and down, a couple months ago, we saw it really spike up. That impacts our interest rates directly. When you hear about the Fed funds rate, and you hear about what the Fed is going to do and what Powell does and so forth, that doesn't impact us in lockstep with those Fed fund rates. So, things like credit card debt and prime rate at your bank, those are impacted right away. But for us, we're driven off of market sentiment, and that has a huge impact on our rates because our interest rates are they directly coordinate with what happens in the equities market. So a good day in the stock market, you should see the yield on the 10-year Treasury adjust up a couple days later when those trades start to settle. So keeping that in mind, I go back to my previous statement about we're in a transition mode. So much of what happens with our interest rate is based on these news reports that come out. Like on Wednesday, we're waiting for the consumer price index numbers to come out. Last week, we saw what the Fed did with their rate hike. Now, even though our rates aren't in lockstep with that, it still moves the market sentiment, right? It pushes people to either buy stocks or liquidate stocks, and they adjust their portfolio, and how they adjust their portfolio impacts what happens to those Treasury yields. And that, as commercial real estate investors, that's what we watch more than anything else, what happens in those Treasury markets.
So Shad, do you have anything to add to that, especially coming from the residential side?
Eric pretty much summed it up. I think just a misconception when we automatically hear news from the Fed and what the Fed is going to do, and we know how much that impacts our whole economic landscape. It's popular to contrary belief to think that that automatically affects the rates that Eric or myself are operating under. And I think that we do know that there's some level of indirect spillover, but it is not a direct, okay, the rates, the Fed announced this rate hike. In fact, Eric might be able to jump in. I mean, the most recent rate hike, our rates dropped. We had a nice 3 or 4 day run where our interest rates, at least in the residential 1 to 4 unit landscape, they actually dropped. And for like a whole weekend, it felt like a back to school sale, right? It was just this massive onslaught of lock, everybody lock, because we never know how long that those rates are going to be the way they are. And right now, the rate market is such a volatile market where we're seeing any change in the performance of bonds, which is, like Eric said, truly the direct force that affects us. Any change is more likely to change it more plus or minus now than ever before. We've never seen really rates go up a quarter point in one day. We may take a full week to gain a quarter point, but now every day could be a full, quarter point, half point swing because of the market that we're in right now and the volatility being at an all-time high.
So with the way that things are going and the way that the economy is, would you say that we're in a recession? And if so, how long do you think it will last?
Well, I think to be in a recession, I always say the business has trained me to elevate my IQ, much like the gentleman on this phone call. But the business, I've learned over years, certain terminology or certain market vernacular. And I believe to be a recession, I think we need 2 consecutive quarters of economic contraction. And so we've seen some level of decline in those first 2 quarters of the year, but there's so many other factors that say it's not a recession, right? But there's certain gurus that say, oh, come on, we've been in a recession now for weeks or maybe months. So we have seen some level of contraction. Many of us in this business, on the financial side of real estate, we know that when we hear bad news in the economy, there's some creepy mortgage guy going like, yes, because he knows, that rates are going to be low and that's going to elevate, a stimulated demand for us, right? And so bad news in the stock market or bad news, globally usually means good news in regards to low rates and certain buyers in certain aspects winning. In terms of the recession, whether it comes or not, whether you think that we're in it, we're going to see some kind of contraction, to me, in my eyes, at least for the next 12 to possibly 24 months, somewhere maybe in between. We are most likely going to see some type of dip in the interest rates. Again, we know inflation is driving that market up, trying to cool off demand, which has been record high. But we do see some level of contraction in the economy, and that's going to end up most likely dropping rates, and you'll see another refi boom most likely in the next 12 to 18 months.
Shad said something there that's really insightful. And well, I mean, that all of it was insightful, but there was one thing in particular that he gave you a timeline that you really need to pay attention to. And that's 12 to 18 months, because anything that's happening, any of these governmental policies or any impact that the Fed has on the economy typically takes 12 to 18 months to move through the plumbing and actually impact us as consumers. So it's very insightful that the information that he's giving you right there, because this stuff doesn't happen overnight, right? So what we're seeing now are these Fed funds rate that we hear it in the news, and then we say, well, things are still going strong. We just doubled our job expectation, right? 528,000 jobs or something like that. What's inconsistent about this? You got to listen to him, because what he's saying now is what you see the Fed do now is taking 12 to 18 months to move through. And that's why we hit what, spring, summer of 2023. That's when you see things peak, and then they start to pull back. That's when you look at the futures market and you study something called a forward curve, which that's when it starts to pull back again, and you see these low rates that Shad's talking about. So are we in a recession right now? Well, as he said, technically 2 consecutive quarters of contraction. We've seen that, but it hasn't been officially declared because of all the other factors. That's the common conception, is 2 consecutive quarters. But the National Bureau of Economic Research is who actually declares the recession. And the White House never likes to declare a recession, right? You can't help but sprinkle a little bit of the do not mention politics into everything, right? So the fact that so many other components are still going strong isn't allowing them to declare the recession. The fact that, you look at the core CPI numbers relative to just CPI. CPI isn't including your foods and commodities, right? Well, now with gas prices pulling back, it's going to be a huge difference in some of these numbers. So we've got to watch the core CPI, and you've got to watch the longevity of these employment figures. From what I'm reading now, and again, I'm not making this stuff up, I'm just reporting what I'm reading. We see these jobs figures because people have been struggling to find workers for such a long time. They're not letting them go, right? They're not letting them move. So these job numbers very well may hang in there. We're seeing wages grow as well. So, again, whether it probably will get declared, but they're not going to run too fast to declare it, in my opinion.
As has been reported with the interest rate, there also has been reports of job offers being rescinded. What do you think will happen if stagflation occurs?
Are we already there? I mean, when you look at stagflation and describe where we're at right now, is that another thing that's retroactively going to be declared, right? We're in a time where we're still seeing prices rise. And I mean, I know what the job growth is doing, but what the jobs are doing, but again, is that sustainable, right? So I have a feeling if we look back a couple quarters, we might see that we're already there.
I always mention to folks to get a little granular. And again, not everybody's going to have time to get granular, right? But what type of jobs? We did see with this increase of 528,000 jobs, we've seen that wages also increased, right? Wage, I think 0.5% on wages, which was also unexpected. But we also, those of us who kind of dug a little deeper, seen that a lot of those jobs were part-time jobs. So not every jobs report is our friend, right? And we're going to have to take a look at this over the next 12 to 18 months to see if this is a trend that's sustainable, but also are these jobs quality jobs? Are these jobs where, the earnings are there? And is this just a one-off, right? What are we going to be seeing in the fall in terms of jobs? Are we going to see a holiday bump in terms of jobs? So a lot of this stuff takes so long to bake, and we'll start to really see where we'll be over the next 12 to 18.
That's a great point. What types of jobs? Because we're moving to more of a services-oriented job growth rather than a producer-oriented job growth. And so you want to watch something called PPI, the producer price index as well. What Shad said, again, is really insightful and something that I should have mentioned myself. The jobs that we have, when he says what type of jobs, services, that's the one. So when these PPI numbers come out and they see those dip, what's that going to do to the Fed? Something else to consider. Just more things to go look up and more research to do. I think one of the macro concepts that we have to keep in mind too is everybody on this call is focused on putting roofs over people's heads, right? It's not as though we have a luxury widget. We're not selling yachts to people. And I feel like that's why we are where we are, whether it's single family or multifamily. We're still tapping into a fundamental need that people have. And I think we're going to fare much better than other sectors.
B. Ferry, you have a question? I see your hand up.
Yes, and thank you guys for all of the great information that you are giving. I'm wondering what is the difference with when you are going towards commercial and you have no background, no portfolio? How would you be getting that building or that 5-unit or 6-unit, even if it's just smaller like that?
When you're doing those smaller multifamilies, say under $1 million loan request, you're going to want to stay local, and you're going to want to leverage those local relationships that you have with your depository lenders. When we go to some of these national hedge funds, they look for previous experience. Working with somebody like Shad or working with Shad to pick up a couple duplexes, pick up a couple quads, right, and grow that experience. Because when we can present a portfolio of some duplexes and some quads, and then you go and you want to present for that 15-unit property, I can leverage that as experience. But going in straight away without that experience, typically we're either going to partner with somebody and that does have the experience, or you're going to build that residential portfolio, the duplexes and the quads, and then we leverage that to get into the bigger stuff.